First of all, thank you for coming, and we'll get into what we're going to cover in a couple of seconds here. So I'm with Willie Jeevers here. Hey, Willie, how are you?
Good to see you. Thanks. How are you doing?
It's good. Good to see
Glad
you.
to be here.
It's kind of fun to be here on a Thursday night. We have a lot of friendly faces on our screen here. So Willie and I go back. How many years, Willie?
Gosh, when Jack was 3 years old and Trey was 3 years old, so
Yes,
yeah, almost 20 years.
20 years.
So been a while.
Our kids are best friends, so they hang out. So that's been a while, Willie.
Yeah.
Makes us feel a little older.
I know. I feel old just thinking.
We should have bought the whole of Issaquah 20 years ago.
I know. Yeah, and Bellevue. That would be great.
We wouldn't even be here right now. We'd be with Casey in Bellevue probably. So, well, let's get started. So, first of all, thank you for coming. I really appreciate you taking time out. And the conversation tonight really is about why real estate. Real estate is a very popular thing right now. There's a lot of emotion in it, a lot of hype. And people ask the question, we need to, what's it all about, Willie, right? So we want to try and bring a conversation together that brings a clarity in the process. So we're going to look at why real estate is popular, what's involved with the buying process, and then how to evaluate real estate. And then we're also going to cover the common pitfalls, and then look at some financing options as well. We'll get Casey Onus on from Guild Mortgage, a good friend of ours. And then we're looking at the benefits of owning real estate. Why is that a benefit? And there's so much happening in that world. We could take all night on that there.
We could.
But we'll get it all done within 1 hour. So if you have any questions, please lean into chat. So I'll try and address these at the end. Any questions come up, we'll address that. If not, we can maybe circle back later on there. So that's what's happening right now. So we're going to stop sharing the screen here, and then we're going to jump into why real estate, Willie. So let's just jump in there right now and get going there. So first of all, thanks again for joining us, and we look forward to getting to see it and do face-to-face in the future, but hopefully that'll come sooner.
Sooner than rather than later. Good. Yeah. Well, welcome everybody, and thanks for joining us. Steve asked me to join the call today and talk about real estate and why real estate is important from a wealth management and financial security point of view. So let me set the stage. So think about our parents for me, like Steve's parents, Steve's mom and dad, or my mom and dad, or maybe your parents. A financial life a generation ago was pretty simple. You had you probably worked for a company for 20 or 30 years. When you finished your career, the company paid you a paycheck or a monthly pension when you're done. You had your Social Security, and you could start that earlier than you can today. And you probably had a 401k. So for my parents, for your parents, for a lot of people a generation ago, it was very easy to reach retirement security. You put your head down, you worked. And when you finished your life at the end of your work career at 50 or 60 or 65, whatever that was, you had your monthly paycheck, you had your 401k, and boom, it was done. So very simple, very easy, and didn't take a lot of work or effort as long as you just did the basics. So fast forward today, for most of us, life is completely different. We don't have a pension. Most of us don't. My boss doesn't give me one, and Steve's boss doesn't give him one either. And even the old line companies like Boeing and Packard have eliminated their pension plans. So here's what happens today, you guys. There's no pension. Social Security is very shaky. The younger you are, the more you have to worry if it's actually going to be there. So bottom line is there is no organization, there's no company taking care of you. If you don't take proactive steps, when you get to the end of your working career, you may not be able to stop working. It's the old joke about working at Walmart. Well, again, the problem is no one's taking care of you. You really have to be proactive and take care of yourself. And if you're not wise about this and take care of yourself, you could be in trouble later on. So we realized this at our firm years ago. We started to see lots and lots of what I like to call HENRYs. HENRY stands for high income, not rich yet. And maybe a lot of you are in this group too. And we would see these mid-career people that made lots and lots of money, but they had no path and no plan and no strategy to achieve financial security. And they weren't rich yet. And here's how I would define rich, and here's how a lot of our clients define rich. Rich means that you don't have to work if you don't want to. So our service is pretty simple. What we do is we help people, we strategize on developing multiple buckets of passive income to try to get to the point where if you don't want to work, you won't have to anymore. And guess what? One of my favorite buckets of passive income is, well, it's real estate. I love real estate. I'm a big fan of it. I'm very enthusiastic about it. And real estate's a great way to generate passive income. So that's my perspective in thinking about it from a planning point of view. So our firm doesn't broker real estate. We don't buy it or sell it or manage it. We simply coach our clients about that. And Steve asked me to join him. He's a fabulous real estate professional. Steve and April are amazing people. I've known them for years as friends. I've known them professionally for years. And Steve has helped a lot of my clients both buy and sell real estate. He's helped my wife and I purchase real estate. So He's an amazing guy. And what I am, I'm the geeky numbers guy. So I'm here to talk about the numbers, and Casey's here to talk about the financing, but I'm the geeky numbers guy. And what we'll talk about tonight is how do the numbers work? Do they make sense? And how do you integrate real estate into a wealth plan or a retirement plan?
That sounds really good. So let's jump in here and talk a little bit quickly at the beginning on why using a buying process, right? So I think we should cover that first, really. So a lot of times in this environment, what we're seeing is very simply, there's more buyers than sellers, right? It's investment, residential. So there's a tension, there's a stress, and there's an emotion through that. So a lot of people are asking, how do we step in and initiate the process of being an investor, right? So I want to run through this really simply. It sounds really simple, but if we have this process, what we'll find is as we go into each process or each property, what we'll find is we won't make mistakes. What I'm seeing is right now in the olden days, we look at a piece of property, you go visit it again, you drive it, you speak to the city, you look at the zoning, you revisit it again, and then all of a sudden you say, this is the one for me. That might take 2, 4, 5, 10 days. Today, what I'm seeing is you see a property you like, you have to buy it. It's just like that there. So I'm going to quickly go through a quick process. Maybe take some notes on this. It's very simple, but what I suggest we do is every time that we go into real estate, the purchasing acquisition mode, my suggestion is that we go through the same simple process every time. And you develop the process that works for you, right? Everybody's different, but I'm going to give you a simple process here that works for me. So the first thing is, that I found is you want to make sure you're with your own a local real estate broker or somebody who knows your area, right? What I'm seeing is there are a lot of national people involved that come in and they're buying all over the nation. I suggest that you find somebody local, whatever you're buying. That's the biggest thing I start off with. The second thing is we need to get financially approved with your lender or with your finances. And what does that really mean? I think we have to make sure we're comfortable with what we're buying. So before you enter into the acquisition process, what do we feel comfortable with, right? So I like to have these conversations away from the transaction. We call it buying the puppy process. The idea is if I take you down, my kids down to buy a puppy, you walk in there, you pick the puppy up and you go, I need to buy it. And all of a sudden you have this puppy and you're trying to buy it, but you haven't thought through logistically what happens when you bring it back to the house, right? So get somebody local, get pre-approved to get your finances in order. Second thing is you need to figure out the math, right? What's the math? And what is that? It's not so much the numbers that you'll talk about, Willie, but what I like to see is what are you comfortable with? Some people want to spend X amount of dollars, a down payment, what's your risk threshold and your bigger portfolio. So I think we want to look at that and really look at what you feel comfortable with. And what I'm seeing is right now, people have a number in mind, say it's $1 million property, and you go into this marketplace and there's all the emotions, all of a sudden you're spending $1.2 million, $1.3 million. I think that's not a good idea. I think we look at this more strategically before you enter into the marketplace. Next thing is actually finding the right property for you. So what does that mean? Is it a duplex? Is it a triplex? Is it industrial? Is it a single family home? I think we have to drill in before we enter into this kind of emotional hype right now and make a decision as I want to buy a residential property. I want to buy a fixer. I want to buy whatever, right? So once you know what that is, make that choice. Then you're speaking to your lender, you're doing your research and you're drilling in and really getting familiar with the area. Once we know the area and you're familiar with what you're looking for, then it takes away the mystery of it. What I'm finding right now is people come in and they want to buy something, they charge to Snohomish, they charge to Seattle, and they go buy it. Well, I would think, no, we need to figure out, I want to buy a single family home, I want to know the area, and I want to know the school district. I want to know how to get there. How is it close to your home? What's your threshold of risk, right? So that's your process. The last thing is, once you know your money, your realtor, your location, then you get into the numbers that you'll talk about in a few minutes, the pro forma. What's your actual number you want to go after? What's the math behind that? Does that make sense? So that's your kind of simple process. Last couple of things is, and we could spend all night on this, but what's the due diligence in your process, right? What's your due diligence process? That means looking at the rents, looking at your rate of return, looking at the seller disclosures, looking at the age of the property, looking at the school districts, and really having a process in place that you know, like for like, apples for apples. So for example, due diligence process on your leases, does that lease, say the income is $1,000, does that include utilities? Does it not? So you're comparing apples for apples. Right. So going through that process, once you have that, then you do submit your offers, and then you're now a property or investor. So that's your simple process, Willie.
Yep.
It sounds really simple, but when the emotions come into play, I want to buy something, something comes up we really like. If you miss that, that can be a problem.
Yeah. And I've worked with Steve on this, and I've seen this process, and he does a wonderful job coaching people through this. So it's a
Thanks,
very
Willie.
powerful process, and it works very well.
Yeah, thanks. So evaluating the process.
Yeah. Well, so Steve took you through all the hard work, the real estate side. Again, let me. I'm the geeky numbers guy, so let me go back to that. So I'm going to throw up something on the screen here for a minute, and I'm going to ask you to forgive me. I love numbers. You're going to see a whole bunch of numbers here, so just hang on for a second, and I'm going to walk you through this. And don't be intimidated by this, but I want to walk you through a deal. So here's a Seattle duplex. I actually took this off the multiple, so this is a real deal. And I'll tell you a little bit about it. It's two units. It's $1 million. I made some assumptions about it. We put down a down payment. There's a little bit of renovation we need. We've got some closing costs. We've got some reserves for vacancies. We made some suggestions or guesses on what the expenses might be on a regular basis. So we know a little bit about the property. And the question is this going to work? Does this make sense? Well, there's 5 areas you really want to evaluate from a numbers point of view. So once Steve takes us through the type of property and the neighborhood and the due diligence and all those things, then we can take a look at the numbers and say, hey, does this really make sense from a financial point of view? I've had a client I worked with for years and years, and he was a very, very wealthy commercial real estate man, owned office buildings. And he told me something years ago at the beginning of my career I've never forgotten. And what he told me, he said, Willie, he said, you make money when you buy and not when you sell. And what he meant by that is if you're buying at the right price, the deal makes sense, you made your money when you purchase the property. And that's what we're trying to do here. We're trying to copy the advice that very wise, very wealthy guy told me years ago. You want to make sure you're making money when you buy. So let's walk through this duplex, and I'll show you an example of how we'd evaluate this. Number one is cash flow. So that's something that we think about quite a bit. And if you take a look at our spreadsheet here, what you find is the rent numbers. After you take away the mortgage and insurance and expenses and everything else, our guess is that we've got about $58 a month in positive cash flow. So you might say, wait a minute, are you serious? I just bought $1 million property and I'm getting all this rent, I'm doing all this work. You're telling me all I'm getting is $58 a month? Is that a good deal? Well, it is, it is something to think about. And from a return point of view, if your down payment and renovation costs and out of pocket is $240,000, that cash flow works out to 0.29%. So certainly that's not very exciting, and that may not motivate you to buy the property. But that's not the end of the story. Let's dig in the numbers a little bit more and see what else we see.
So just to understand, I know these numbers are small on the screen. So just to understand, Willie, so what you're having, you have your gross income.
Yes. Yep.
Then you have your monthly principal and interest.
Yes.
Your taxes, insurance, any associated fees. You take all your expenses off it. So gross income, vacancy, all the expenses, and at the end of that, you're coming out with basically 0.29%.
Right. Yep.
Okay.
Yep. In real estate lingo, they may call that net operating income or NOI. So what we're trying to calculate is at the end of the month, how much money do you have left in your pocket after you've paid all the different people for out there. So anyway, first shot through, the numbers aren't very exciting, and you think, well, that doesn't look so great for a $1 million duplex. Well, there's a second part to it, and that's leverage. We'll talk more about that in a minute, and Casey will hit that in more detail. But you just bought a $1 million property, and you only came out of pocket, in this case, with $240,000. So there's a lot of advantage to that. I'll show that to you in a minute. Number 3 is debt reduction. So I'll tell you a funny story about this. I see my oldest son on the call with this, so he'll remember this. But I've got 4 kids, and my 4 kids grew up with a very geeky financial planning dad. And one of the things I told them, one of the principles I told them was, hey, you guys, don't ever borrow money. Don't ever borrow money. Don't ever borrow money. But if someone else is going to make your mortgage payment, then go ahead. And that's what's happening here, you guys. We're borrowing money, and somebody else is making our mortgage payment. So Casey can check my numbers and see if I'm right here. But if my amortization is right, then in the first year, the mortgage payment that our tenant is making for us works out to $14,792 in debt reduction. So in other words, we built more equity in the property without doing a single thing. All we did is we took the check from the tenant, we gave it to Casey or gave it to Guild Mortgage, and then we paid our debt, and our loan started dropping in balance. At the end of the year, the first year, we got almost $15,000 in equity. So let's look at the math on that. Again, we put $240 down, we've got $14,000 in debt reduction. That adds 6% a year in return to our deal. So now it's sounding a little more interesting, right? Now it's still not great, but we got 0.29% positive cash flow. We got 6% or so in debt reduction. Number 4 is tax savings. One of the beautiful things about real estate is the income is very tax advantaged. Now, a lot of you, I'm guessing, are very high income. And if you buy a stock or you buy a bond or you have a CD in the bank, the interest or the income you get from that or the gains you get from that will typically add to your taxable income. And unless it's in an IRA account, your tax bracket might go, or your tax bill might go up. In a real estate property, what happens is we get income, but oftentimes the depreciation of write-offs is enough to shelter all the income. So even very high tax bracket investors can enjoy really tax advantage income from the property. And that's, again, a huge advantage. So that's the example of the tax savings. I'll have to give you my caveat. I'm not a CPA. Check with your tax preparer about this, but that's an example of how it might work, you guys. And then finally, and here's where it gets more interesting, is appreciation. So the Schiller Group tells us that houses as a whole have gone up a little over 2 to 3% a year across the United States for about 100 years. So just for sake of example, I said, let's just use that 3% number. What was the appreciation rate in 2020, Steve?
12%.
12%. Okay, yeah. So this is only 3, you guys. So I'm just using the long-term rates. So if the house goes up, or the duplex goes up 3% a year, that adds 12.5% to our return. So you might say, wait a minute, I'm not that good at math, but how does 3% make 12.5%? Well, here is the beauty of leverage. This is where real estate is very powerful for wealth accumulation investment. Remember, you put $240,000 down in my example, but you control the whole property. And if the entire $1 million duplex appreciates, you get all the appreciation, even though the bank owns roughly 3/4 of the property. So $240,000 down with 3% appreciation on the property, that works out to 12.5%. So let's take a look what that means to us as an investor. Here's our projection. And again, these are, as always, these are caveats, you guys. This may or may not work, but this is our projections or our guess. We think this investment in the first year alone could have a little bit of positive cash flow. We're going to get some return to us because we're going to increase our equity by reducing debt, and that's worth 6%. And if the house or the duplex goes up 3% a year, we think that's 12.5% appreciation. So that works out to a 19% return in that duplex. All of a sudden, that kind of gets your attention, right? Mm-hmm. By the rule of 72, if we're earning 19% a year, that means your investment's going to double what? About every 4.5 years, or so, actually less than 4 years. So it's really works out well. And let me give you an example as a wealth manager. We manage over $150 million out of our firm in conventional stocks and bonds. If I could tell people that they had a pretty good chance or a very good chance of earning 19% a year on our stock and bond portfolio, I would have a traffic jam, you guys, all the way across Murphy Island to my office in Issaquah. I mean, people would be lining up to come here. That's a sensational rate of return. And let me give you another benchmark too. If a client comes in and says, listen, I want to do a real estate deal, what I tell them is, if you invest in stocks and we earn 8 or 9 or 10% a year, whatever the historical average is, that's easy money. We don't have to change out toilets or get calls in the middle of the night. There's no work involved there. So your real estate investment ought to have a higher return to reward you for the risk and the work you take. And my suggestion is you probably ought to hope or project a return somewhere in at least the mid-teens to make that attractive. So again, what might look like not a great investment when you dig into it, gosh, it looks pretty good. And whoever bought this duplex, and I think Steve and April were very involved in this, whoever bought this duplex a couple weeks ago, I think will be very, very happy in the future. So again, that's how you dig into it. Let me give you one more thing to think about. This is the beauty of real estate. So Steve might show this duplex to you and he might say, well, Willie, this duplex is underutilized. The manager hasn't taken good care of it. They haven't done a really good job with the rents, and the rents are under market. And I think you can raise the rents up a little bit. It's a very common story. A lot of the older baby boomers own duplexes and apartment buildings, and it's very common to see rent slope. So let's suppose that you could increase the rent by $500 a month for each unit of the duplex. And maybe that's a little dressing up and landscaping and new granite countertops or something, but it wouldn't be unusual to be able to increase the rent. So look what happens, you guys. If we increase the rent a little bit, all of a sudden we jump our positive cash flow to 5% a year, and now the deal looks like it might be returning almost 24% a year. And let me show you one more thing too while we're doing this. Again, I assumed a very low rate of return on the appreciation, but Steve tells me that we were up 12% last year. Just for fun, Zillow says that we're going to appreciate 4.9% next year in Bellevue. If we just assume that and ignore the 12% number that Steve just gave us, let's see what that turns out to. Oops. I just pushed the wrong cell there. Let me try that one more time.
So the idea, Willie, is if we're looking at appreciation
Yep.
in an area, so conservatively 3% would be really minimal.
Yeah. So if appreciation goes up to 4.9% a year, again, which is far less than it's been last year, the year before, your total return, you guys, goes up to 26.8%. So again, this is where real estate is very magical, and where a big year like last year can make real estate work really well for us. Let me show you one more thing. Again, this is for folks that struggle a little bit with numbers. Here's a really simple chart. And what the chart shows is two things. The red line is the value of the property. So if it keeps appreciating, we hope it does, the property goes up and up and up. And the blue line is your debt. And remember, the tenant's paying your debt, so the debt goes down. So the difference between your debt and the market value of the property, Steve and Casey would tell you, is your equity. And you can see as time goes on, the debt goes down, the property value goes up, and your equity grows and grows and grows over time. So very powerful. In my world, I would call that a get rich slow strategy. You're going to get rich, and it may take a while. This is a 10-year chart, but you'll get rich slow. It's a very powerful way to grow wealth. Finally, let me show you one more thing. Back to the numbers. So give me, bear with me, you guys. But remember, in our first year, we thought that, let me go back to our original appreciation number. In our first year, we thought that the return might be about 18%. But here's the powerful thing about real estate. Casey's mortgage is probably going to, or will stay fixed if we get a fixed rate mortgage. Some of our other expenses may go up a little bit, but it's common for rents to increase. So I'll give you a personal example. My wife and I have bought a rental house. One of our rental houses we've owned since 2004. Our rent that we got last year is about 2.5 times more than we bought the house.
Wow.
Almost 18 years ago. So if you look at this chart, it shows the rent slowly increasing over time. And as the rent increases, you can see that number slowly creeping up. As you increase your rent, you'll see that it's going to increase the return you earn every year. And that number increases pretty dramatically over time. So again, get rich slow. The deal keeps getting better and better and better as time goes on. And then finally, if you go back to my original comment and said, well, what does life look like for passive income? At the 10th year, we're suggesting that the rental income might be $7,500 a month. We're still making mortgage payments. You'll see those expenses there. But when we eventually pay that property off, that's a pretty significant chunk of passive income. So for those of you without a pension, like Steve and myself, and maybe everyone on this call, this real estate property might really be a great contributor to more income and more more passive income over time.
That's amazing, Willie. That's really good. So just to summarize what we're hearing here, there's a process, there's graphs, there's charts here. But I think what we're hearing is, what I feel is, as a realtor, there's a kind of emotional component.
Yes,
right.
Very much so.
There's an emotional component where you go in and you see this a beautiful property, and what you're doing is bringing the emotional side and the numbers side together.
Yeah.
Right. And I think that's what we really need to really look at and focus at, because there's a property, it could be worth $1 million mathematically, but it is a gorgeous property. And that's why I love it about real estate. You look at some property, all of us can go, that is just a beautiful property. So I think what we're going to look at here is, how do we tie numbers in with a good property and a good location?
Right.
Right. So let's jump in here. So I want to just touch on, as a realtor, as a person who's in the field every day, there's definitely a lot of conversations where there's pitfalls. So what can happen is, the puppy analogy, you go down to the pet store, you see the puppy here, all of a sudden you bring it home and this thing grows up and you don't like it. It's a big dog, right? So I think for us, what we're going to do, I want to touch a little bit on things I'm seeing today that we have to watch for. Just really simple. But what I'm seeing in this kind of climate or environment in the Northwest, there's more people coming in than leaving. So there's kind of things going on to look at. So first thing is, I want to say, and it will take me 3 or 4 minutes, this is more the negative side of real estate, but I'm trying to be really pragmatic here as a realtor. So first thing is, we've got to stick to your system. So all the mistakes I'm seeing recently is people get too emotionally involved, and what happens is they buy something and they think, what do we do? Right? They literally see a property for 15 minutes we're buying it, it's aggressive. And that's, to me, is not a healthy way to go. So I want to just go in. The pitfall is time is of the essence. So research before you get there, and that will help you. Second thing is really knowing your area. What I'm finding is people are doing too wide a search. I want to buy a house. We're working with a person right now. They want to buy an investment property between Everett to Tukwila.
Wow.
Right. And to really, to me, that's a lot to process. If that's your first investment, I think we've got to drill into an area you like and really get to know it really, really well and watch it over time. Right. So it's a non-fluid deal. Next thing is there's a lot of VRBO situations going on here, right?
Yeah.
So what I'm seeing is with new construction is there's more and more covenants coming through. So maybe you can't rent out short term. So your HOAs, your covenants. So make sure if you're buying something, a common pitfall is we buy it. April and I were working on a project today, a beautiful little property with waterfront, and there is some covenants in place. So you have to make sure that what you're buying is what you want it for.
Yes.
Right. So a common pitfall is you have to watch you'll be able to buy that. Next thing is make sure you're hyper local. So what does that mean? Is there's lots of landlord tenant laws. If you're in Seattle, if you're in Washington, or you're national, there's different regulations. So make sure you know what you're dealing with in these areas. Is there a flood zone? And also getting the right financing is a big deal. What's your plan? Are you going to own it for 2 years or for 30 years? Right? If it's downtown Issaquah, like you know, Willie, is you probably want to lock into long-term financing, right? And last thing is what I see is, or two more things, is being emotionally involved with the property, right? And this is an investment. And what I'm finding is a lot of people, they buy properties and they try and remodel it to what they feel is how they live in it, right? As opposed to what the market, if it's a $3,000 rent, what is that rent for? And then maybe build to what the market is, as opposed to what you think it is.
Yeah.
So really knowing your market is a big deal. So that's just some common pitfalls. It sounds really simple, but when you're in the marketplace, I see that a lot happening.
Yeah. And when the heat is on and the offers are flying and people are bidding on properties, it must be difficult to keep focus on those.
Totally, Willie. And what I'm seeing,
pitfalls.
and if you see like the market going up 12%, 10%, 15%, how do you jump in there and have your due diligence done at the same time as you see this thing market taking off? So yeah, that's a big deal. So we'll jump in. We've got Casey Onis here from Guild Mortgage. Casey, are you around? Can we see your face?
Yep. You see me?
Hey, Casey, how are you?
Great. How are you?
Good to see you. Well, Casey is a lender. We've done a lot of stuff together over the years. And I wanted to bring Casey in because financing is a big part of the story, Casey, right?
Yeah, absolutely.
And so let's jump in a little bit specifically. What's the difference between getting a loan on a personal property and on an investment property?
Yeah, for sure. And just to maybe piggyback before I say that, I think one thing that it's really important, especially in a highly competitive market like you're in, is to have a really solid team. I think Steven and Willie talked about that, but like from what I see out there with some of my investor clients, is it's not always about having the highest priced offer, but it's just having a solid team around you, because you can work together as a team to put together just the cleanest and best offer rather than the highest price. So I think it's really important to just touch base on. So I appreciate being on here with you guys. But when you're looking at the question was about personal property, a primary residence versus an investment property.
Right. Yeah.
Yeah. So usually it's around the down payment. I think there's some pretty cool things about buying an investment property specifically, that it can sometimes in a way be easier to qualify for an investment property purchase than a primary residence purchase. Okay. The reason I say that is that when you buy an investment property, so like in the example that Willie used with buying a duplex, if you're to buy a duplex strictly as investment property and you're okay with the down payment of 20 to maybe 25%, you can actually use the projected rents on that property to help you qualify. So hypothetically speaking, you buy a duplex, each unit's renting out for, I'll just use simple math, $1,000 each. We as a lender will use 75% of those projected rents, $1,500 of income, and add it to your monthly income, which will help you qualify. If you were buying a primary residence, we're not going to give you any extra projected rent income right there, right? So it's a nice little feature that I see as my clients add more and more rental properties to their portfolio, that they become more and more qualified, which would seem kind of counterintuitive to what you would think, because you're carrying more of a debt load, but the cash flow over and over adds more income than what it is. And so
Okay. That's super helpful, Casey. So what you're saying is 20 to 25% would be a really healthy down payment.
Yeah.
$1 million property, 25% down, and then you can then write off that income from the rent, 75%, which basically alleviates or mitigates the calculations.
Yeah, and based on where like some of the rates are today,
Yeah.
I mean, sometimes those projected rents
Yeah.
cover the entire monthly payment of what the payment is right now. So, you know, right off the bat, they're 75%, and the reason we use 75% is to kind of use that vacancy factor that Willie suggested, right? So, hopefully that answers. And I think
that's really super. So what's the difference between, I think, because a lot of people want to buy single family homes right now in Bellevue or the east side. Maybe not so much downtown Seattle. It's a little more, it's challenging right now. But if you're looking to buy a property, is there a difference between the interest rate of a residential single family home for yourself or a non-owner occupied property?
it is a little bit different. So typically, on average, it's about 0.5% higher buying an investment property. So, you know, historically, well, I'll talk about last year. Last year rates obviously hit these all-time lows. We're in the low twos. We were helping people maybe in the or high twos-ish, mid twos, helping people buy investment properties in the low threes or sometimes even high twos. So, but you can also use some of the tax benefits of an investment property to buy the interest rate down, especially if you have the long-term buy and hold mentality. I think you both talked about like knowing, or one of your things was, you know, how long do you plan to keep it? Is it 2 years, 3 years, 5 years, 30 years? That will kind of play into how you plan around the mortgage and whatnot.
Right. Okay. And then, so last couple of questions here. So 4 units or less, what's the significant about that, Casey?
Under 4 units is considered a residential home loan. Anything above 4 units is considered a commercial loan. So on a residential loan, we're going to look at you as an individual borrower, and we're going to qualify you based off of your credit, income, assets. It's going to allow for less down payment. Commercial property loans require more of a down payment, and they will underwrite to the property itself. And so usually require a much larger down payment, and you can't do like a normal traditional 30-year fixed type of loan, which in these kind of situations is kind of what I think Willie was showing there. You can lock it in, carry it for 10 years, don't have to worry about the monthly payment going up, but projected rents are going up. And that's where you're getting that massive return over a long period of time. So,
and Casey, those are residential loans for 4 units or less. Those are non-recourse loans.
correct.
In other words, the loan is collateralized by the property. So if something goes wrong, you lose the property, but you don't lose your own assets.
Yeah, and a lot of my investor clients, after they close the loan, they'll quit claim it into the LLC. If we ever look at refinancing it at a future date and time, they'll quit claim back out. We'll do the loan, then they'll quit claim back in. So protecting your, keeping this out of your estate in a way. I'm not an estate planning attorney, but I see enough of it that have helped clients do that. So I think that's a big part of it too. And I think one thing that maybe you guys are going to touch base on, but it is, as sometimes that chart really was really cool to see, the value going up, the principal going down, and that's the buy and hold mentality. But if you also use that equity as additional leverage for a future investment property, 2, 3, 4, 5 years down the road, pulling some of that out, rolling it into another one, and keep seeing that. I've had a few of my clients, 5 years down, they've bought a property every year. You look at their net worth when they started to where they are now, it's pretty unbelievable. I mean, we did have a nice run in the Seattle market, but I think real estate in general is a great long-term investment strategy.
So the last question, Casey, is that they have this pressure. There's very few homes available and investment properties, and the interest rates are starting to nibble up a little bit. Would that be your forecast? Or talk about interest rates? What do you see happening?
Yeah, I think we're going to see rates kind of trend upwards a little bit. I think they've been at these rock bottoms for the last year, and I don't think anybody expected them to be there. But if you guys think about historically where rates have always been, being in a low 3% or even mid 3s for investment property is unbelievable right now. So buying right now, I mean, I have many clients over the years. I've been doing this for over 10 years now. I have investment property rates at 6.5, 5.5, whatever, and now you can still be at 3.5. I mean, the leverage opportunity is unbelievable. And I think the other kind of added piece to that is when you are looking at multifamily properties, you can borrow up to $1.5 million in the 3 major counties here in Washington on a conforming loan at those levels. So the leverage play is pretty unbelievable. Buy a $2 million house, 20 or 4, let's say 4 unit, 25% down, $1.5 million of financing. You know, I mean, not that, I mean, that's a lot of down payment, but you see where I'm going with it. So
yeah. That's amazing. No, it really is, because there's this kind of pressure right now between lack of product or investments in the market. So there's a fight to get in.
Yeah.
But there are a lot of people are thinking the same thing. There's this kind of season where there's people moving in, there's a pressure, and interest rates are starting to go up there. So there's this tension.
Yep. And let me throw in a little kind of confirm what Casey just said. So think about the leverage from the point of view of being a stock investor. So let's suppose you said, gosh, Apple stock is fabulous. I want to buy Apple stock.
Yeah.
Well, there isn't a bank out there that's going to borrow you $1.5 million so you can put 500 of your own money in and control $2 million of Apple stock. You just can't do that. There's a margin debt, and it's you can do some of that, but nothing like we're talking about here, and certainly not on a fixed rate on a non-recourse basis. So the ability to use the bank's money at very low rates to control real estate is unbelievable. And that's one of the reasons that real estate is such a powerful asset, even compared to stocks.
That's amazing.
Yeah.
Casey, appreciate it. Any parting thoughts before you leave?
I mean, I've seen a lot of real estate agents and planners and out there, and I think, you know, it's super important that you have a good solid team behind you, and that's ultimately what it really comes down to. So I can speak for these two guys that they know their stuff, and so it's pretty awesome that they're doing this and just sharing the data out there, because that's the biggest thing is education around it and getting a plan and a process in place. So I think everything you said, I just already took a whole back page of notes, so I feel pretty good about it.
Thanks, Casey. Appreciate it. Thank you. Thanks for your time.
Absolutely.
So, thank you. So I'm going to jump in and talk with Willie here. So I wanted to lay out a thought process here. We're looking very hyper local micro here, right? But what Willie's going to talk about is more the benefits, what's happening in the nation, what's happening with the feds, what's happening with money, and start to look into a bigger picture thinking, so that we can kind of lean into why is this pressure cooker? Why are we feeling all of a sudden everybody wants a piece of real estate?
Yes.
Right. So the thought process is, hopefully you guys can see this here. We go into our slideshow here, but so passive income is number one here. But let's go in and talk a little bit about what's happening bigger picture, Willie.
Yeah. So there are some unbelievable things that are happening economically that make real estate such a compelling issue. And this may be a short window. This may last for a couple of years. You know, who knows? But I want to kind of walk you through what's happening economically. And I know some people's eyes glaze over with the economics, but I'm the geeky guy in the room here. So let me walk you through it. Hopefully make it kind of fun. But there's kind of three things I want to walk you through, and then I want to introduce you to Tina. I'm going to bring Tina in the room in a minute. She's going to really explain why this is so powerful. But before I bring Tina in, let me talk about three things. Number one, as Casey said, interest rates are at levels we've never seen before. If you looked at the trivia slide earlier, you know, you saw that we've never seen rates on the 10-year government bond, the benchmark bond, below 1%, where they were most of last year. And still today, it's still about 1.5%. That's unbelievably low. Here's why that's important, you guys. When bonds are that low, there is not much reason for people to buy bonds. So if I have a client come in and says, hey, here's Willie, here's $1 million, put together a portfolio for me, they're probably not going to get that excited about bonds paying 1.5% or some bonds pay even, you know, 0.25% or less. And so what happens, the bond market is way bigger than the stock market, and people start leaving bonds and going to other assets. They call that the melt up. Money is melting out of bonds, and some of that money is flowing to stocks and to real estate. So what you're seeing here is really, really friendly to real estate, not just because Casey can get you rates that are really low, but because money is melting out of bonds, is flowing out of bonds, and some of that money is going to real estate. So that's number one. Number two is money printing. So again, this is a kind of a boring chart. Let me put some color into it. This comes from the Federal Reserve. If you're, again, a geek like me, you can download this right from the Federal Reserve website. But we are printing money at levels that are startling. And I've been watching this since 2002, and I'm continually amazed by this. You don't see this covered very much in the media, you guys, but let me kind of walk you through the graph there. In the last century, the money supply in our country grew very, very slowly. It grew maybe 2 or 3% per year for most of the last 100 years up to the start of the century. And generally speaking, the money supply grew about as fast as the population increase. The gray line you see there in the middle That's the great financial crisis of 2008, 2009. So all of a sudden, the Federal Reserve and the government said, hey, we have a problem and we're going to try something new we've never done before. And we're going to print money. So all of a sudden they started printing money. Sometimes it's called quantitative easing, but the money supply quintupled from during the great financial crisis. It went from a little under 1 trillion to about $4 trillion. And again, a lot of things happened because of that, but it was a pretty big spike. Once we kind of got out of the woods, which was about maybe 2012, 2013, you can see that the money supply kind of wandered along. It didn't change too much. But here's where the pandemic hit, you guys. And here's the numbers. The money supply at the beginning of 2020 was roughly $3 trillion. It was about $7 trillion at the end of the year, as measured by what's called the Federal Reserve balance sheet. So think about that for a minute. The money supply, last year alone, we created about as much money, or excuse me, let's try that again. In last year alone, we created about 3 times more money than existed at the end of the century. I mean, it's a massive amount of money. You're not reading about this a lot of places. It's a boring subject. It's hard to explain, but there is a massive amount of money printing going on. And here's what it means. That money is going in the system. Money tends to go where it's treated the best. And guess where it's going? It's going into real estate. It's going into stocks. If you're a crypto investor, you might have noticed that Bitcoin has gone up 5, 6, 7 times the last year. This is certainly a contributing factor to that. And gold has gone way up too. So every single asset class, precious metals, cryptocurrency, stocks, real estate have all taken off. And a lot of that is probably due to the massive money printing. And you know what? This is not stopping anytime soon. We just passed, or we're just passing a $1.9 trillion stimulus bill. It sounds good, but here's the thing that you don't read very much or don't read at all. There's no money to pay for the stimulus bill. So they're going to be pushing buttons on the computer at the Federal Reserve. They're going to print another $1.9 trillion of money. And they're talking about a $2 trillion infrastructure bill and maybe even a $2 trillion new Green Deal bill. So it looks like we're going to print even more money this year than we did last year. Again, great for stock prices, great for real estate prices. As a dad, it makes me a little worried. I'm not sure this is sustainable, but for the time being, this is a very unusual situation. And again, remember, money goes to where it's treated the best. And if real estate's attractive investment and interest rates are almost zero, then money tends to flow into, in stocks and real estate. There's a third factor, you guys, and here's what it is. It's inflation. So again, this is a chart from the Fed. This is the last 5 years. The yellow line is the pandemic. And you can see the inflation rates that are just soaring. And the actual rate of inflation right now is not, too high. It's the Fed says it's about 2.5%. But what's worrisome is look how quickly that line is rising. That's very, very unusual. And if you've watched lumber prices, if you looked at the price of other things are starting to creep up a little bit. Here's what it means, you guys, to real estate investors. And I'll give you 2 phone calls today. I've had a whole bunch of client meetings today, and 2 of my client meetings, here was the conversation. Hey, you know what, Willie? I've got a whole bunch of cash that I've been sitting on. My CDs have matured. My money markets are not paying almost anything. I've always liked to keep a lot of cash outside the investments, but now, wow, I'm getting nothing and inflation's going up. What do I do? So there's even more pressure, you guys, for money to flow out of cash into where it's treated the best, and a lot of that will probably be real estate. So again, 3 very, very, very powerful factors that make this an unusual time, a very powerful time. And if you're wondering why real estate prices are going crazy in Seattle and Bellevue, this is certainly a powerful contributor to that. So with that said, let me introduce you to Tina. Have you guys heard about Tina before?
Yeah.
So Tina is not a real person. Tina is an acronym, and Tina stands for There Is No Alternative. There is no alternative. And that's kind of a joke on Wall Street. But what that means is if you have money and you want to do something with it, there's just really no place else for you to go. Let me turn this off here. Stop sharing. Here we go. So there's no place else to go. So Tina is a story. If you talk to a Wall Street trader or anybody in finance, they would know exactly what you're talking about. But the phenomena is this money is being created like crazy. We've got inflation worries and we've got low interest rates. So it creates this gigantic funnel, and the funnel is pushing everything towards real estate and stocks and maybe Bitcoin and gold. And that's why asset prices are going up. So this TINA impact is very, very powerful. And again, it's one of the reasons why I suggest this is a time that you want to, be thinking about, about real estate. Another question that I get all the time is, should I invest in real estate or stocks? And my answer to that is yes, you should invest in real estate and stocks. And again, here's a little quick slide to show you that. We've already talked about some of this, but here's the difference between real estate and stocks, you guys. Stocks might increase in value through appreciation, through dividends. They don't really have a lot of tax benefits. They may be a little bit of an inflation hedge. If you look at the things you want in an investment, you'd love to have the cash return. You'd love to have the equity buildup or appreciation. You'd like to be able to use leverage. Hard assets are great because they're tangible. You love tax benefits. You like inflation hedges. And the only investment that checks off all those boxes is real estate. So when people ask me, should you invest in real estate or stocks? I always say yes.
Yeah.
So my personal life, I'm a huge fan of stocks. I bought my first stock when I was a teenager. Again, kind of a geeky, weird kid. And my kids have all been very active in that, but we also love real estate. And again, Steve has helped my wife and I with real estate. We own rental houses. We invest in multifamily, and it's a wonderful asset. So my encouragement to you is when you're looking at building your portfolio, you want to look at both those asset classes and you want to take advantage of that. And Steve and Casey would be a great resource for that. The final thought, you guys, is let me finish off with three personal financial strategies for highly compensated real estate owners. There's three things to think about. Number one is going back to the Henry plan. So the question is, what's your plan? How are you going to go about creating passive income? You have a high income, you've got no pension. Who knows if you'll have Social Security? What are you doing? What's your strategy? What's your method? How will you create that? So that's something that the three of us could all help you with. It's something that we help folks with. The second, I think we got logged out there, Steve. Did we just lose that, April? Yeah. Shoot, what happened?
Did you log back in?
Yeah, I guess so. Gosh, that's weird. I didn't touch anything. Here we go. Are we back in? Can you guys hear us again?
Yeah,
awesome. Thank you. Sorry about that. We just somehow something happened over here. We're back more. Anyway, number one, do you have a Henry plan in place? Do you have a strategy to create long-term passive income? And again, Steve and Casey and I are all there to help you with that. Number two, the question you want to ask yourself, is this sustainable? Will this keep going on this way? How long will Tina be at the party? And I think I can tell you the answer. It'll be a while, but it won't be forever. So there's a little bit of time urgency here, you guys. If you're looking at buying real estate, if you're looking at refinancing, if you're looking at investment properties, you really probably ought to call Steve and April and Casey pretty quickly, because if history repeats itself, this window will be open for a while, for a month, maybe a couple of months, maybe a couple of years, who knows, but it won't last forever. And what I'm trying to emphasize, this is a unique time, a special time to take advantage of this. And then finally, number three is what I like to call the 30% rule. And my 30% rule says, if you invest in real estate like this, can you hang on if life gets 30% worse? If you lose 30% of your rental income, if your personal income goes down 30%,
right.
If the stock market goes down 30%, can you hang on? What I've experienced in my life is that the folks that are able to hang on through the tough times and come back the other side, which might take a year or two, end up better off than before. It's part of the long-term assets. I think Casey was kind of referring to that when he talked about it. He only used 75% of the rents to underwrite a property. So I always encourage people to use the 30% rule. And if we're evaluating real estate as part of the asset, we'll take that litmus test too and say, listen, can you hang on there? So again, those three powerful financial strategies may be something to apply to the big picture. So, and then finally, we're living through what people are calling the Great Reset. You may have heard that term before, but with the money printing, with the changes in tax codes, with the changes in cultural codes, I think there's some big changes going on from a financial perspective, and I expect a lot of turbulence and a lot of big things happening. Let me share this from my personal life or my professional life. When the last crisis hit, Steve remembers this. We had talked about this a lot in the early 2000s, and I was quite worried. And in fact, I wrote a 15-page letter to our clients in 2007, and I said, you know what, we got some big changes coming up, and we were kind of fortunate. We were blessed. We made some changes. We avoided the bank crisis. We did some good job in protecting ourselves. So I was very happy about that. However, one thing I would have loved to have done is to take advantage of what happened back there. So again, we're living through another time like that where there's a great reset going. And I think what Steve and Casey can do is maybe there's some strategies to take advantage of these things that are going on. So as we're living through this great reset, how can we take advantage of that? What are the proper appropriate strategies? And hopefully we've given you guys some ideas tonight on some ways to try to make your financial life a little bit better.
That's great, Willie. So hey, first of all, thanks for listening in. We had covered a lot tonight. We've covered the why real estate. And I think there's a lot of good information. Well, thanks for sharing that there. Looking at the buying process, what is your process? And you'll find out what you're comfortable with, going a deep dive into actually evaluating the processes themselves, getting the emotional side and put numbers against it and getting familiar with the rental incomes and costs there. It's a big deal. And then common pitfalls is the emotional side. There's a hype and there's a lot of pressure right now, but I think definitely it's worth the fight.
Yes.
I mean, I think we've both had these conversations many times. It really now it's worth a fight. It's hard to buy, it's easy to sell.
Yes.
But I think this is an acquisition time. And then really going into the whole idea of the benefits. I think we're looking at all this money coming in. I look at it as like monopoly. There's still only so many houses on the board and all this money's coming in. So that's a big concern we have, is really looking at the whole inflation situation here, which is really a big concern, I think, for a lot of people. So anyway, we've covered a lot tonight, guys. I want to say thank you for coming and listening and sharing in, and hopefully there's some value to you for that there. And
we can do some question and answer too.
You want to do, April, can we post on chat? If you want to post, I have a couple of minutes left, guys. If you want to post any questions on chat, we can definitely do that. Any questions there? So just one comment on that there. I think I love the analogy of Monopoly.
Yeah.
So Willie and we're kind of competitive at board games guys, right? In our family, we have lots of noise and stuff we play. But I think that the thinking of Monopoly is such a good thought. And I think when I look at real estate locally here, this is on the east side in King County. Here it's an analogy. Any thoughts on that?
Yeah, you taught me that well, Steve. The inventory is what? It's less than a month now.
Yeah, so we're looking at roughly a normal, really, we take a barometer, a thermometer of the market by month supply. So we're typically a healthy market's 2 to 3 months, 2 to 4 months. Right now in most areas, other than downtown Seattle condo market, we're running about 0.6 to 0.7 month supply. Wow. Some areas 0.9 months. So we would say in the olden days, 1 month supply is really indicative of 1% appreciation. So we're looking at, and I've seen this in the east side specifically, if you want to buy a property, in fact, April and I were working on one today, where we're looking at 9, 10 offers. The most offers I've ever seen is 60 offers on a property. So definitely a lot of stress. There's a lot of conversation about 1031 exchanges, tax deferment programs, a big deal here. So definitely there's a lot of strategy, a lot of tax benefits, but really owning in a very tight market is a good place to go right now.
Yeah, and just to kind of circle back as a math guy, if that's 1% a month, that implies 12% a year in appreciation, right?
Right.
Yeah. Wow.
So any comments in chat there? Can you see that?
Do you see any, April, on your side? I don't see any questions over here. Or does somebody want to?
Hey, Stephen, this is Joe Galindo.
Hey,
can you
Joe, how are you, buddy?
Good, my friend. Good. Great presentation, gentlemen. Thank you.
Thank you.
So I totally agree with everything that you all just talked about. Rates are going to go up, as you well know. Great time to buy if you can find a property. I serve on the board at Seattle King County Realtors as one of the directors, and I was on a call about 2 months ago with a bunch of the directors, and Lawrence Yoon, who's the chief economist for National Association of Realtors. And so what Lawrence said was, the window, Willie, to your point, the window on low interest rates is closing because of the Fed printing so much money. We have to pay that money back at some point. And one of the ways we're going to do that is through interest rates. So he said, if you've got clients that are considering buying real estate in the next year or 2 or 5, don't wait 5. The window is going to close in a year or 2. Do it now. So everything that you just said, Lawrence Yoon would be applauding you right now because you're spot on. So great presentation, gentlemen. Thank you so much.
Yeah, thanks
for sharing that, Joe. That was very, very illuminating. Lawrence Yoon is a very, very wise man. So interesting to hear his perspective.
One of the conversations, Joe, we've had is that the whole idea of this work from home environment. So I was working on a plat over in Idaho. I had a look at that there, and all the people are moving out. So all the people from Seattle moved to, I think, the east side. They moved to Chelan, where Willie had a place, and out to Idaho. So you have this whole move away, work from home culture. At what point is that pendulum? Is it going to come back? You know, so there's a lot of conversations in that right now. So we actually are having a lot of investors looking in Seattle
Oh,
because there's some
interesting.
great opportunities there. And at some point, I think the theory is that the pendulum
Yeah.
will come back at some point there. So any more questions?
You had quite a few questions actually in there. I don't know if you guys
Okay.
can hear me, but you may read them to you.
Yeah.
Yeah, that'd be great. Thank you.
Somebody said, Ross Wilson said, is there benefits for buying investment properties in King County versus Snohomish?
You want to go with that?
Yeah, again, from a numbers perspective, you know, I think it's just a matter of how the deal looks. I'd really kind of defer that more to Steve as far as it's more of a locale and real estate question.
Yeah, so I'd add to that, Ross. A great question, Ross. I think the question that we look at is, and I love Willie always talks about, where's the income coming from?
Yeah.
So you're looking at inflation, you're looking at things happening, but what's the actual rental income, and where's the pressure on that? So what we are seeing is locally, specifically in the tech and biotech world and gaming industry. So that's very much strong into just King County.
Yeah.
So I think if I had a choice, I would look at these areas, and then you want to look at the communication paths, which would be your roads and your light rail, and then your school districts. So that's the main things I'm always looking at as a kind of a matrix for a safe option. So it's a long-term play, right? So school districts is a big thing for me. I think if you look at a school district, it self-perpetuates itself.
Yeah.
So that's what I would look for.
Yeah. And to add an anecdote to that, my pastor was trying to write an offer on a house in Snohomish, and they got there an hour after the first open house on Saturday, and I think there were 30 visitors in the first hour and six offers by noon the first day. So Snohomish is quite attractive too. It's bringing a lot of people, a lot of the interest there.
That's a good question. So one of the questions here is, what's the thoughts on buying a property and placing ADUs on the property? So that's a great question. So we're actually working on some investors myself, or maybe 8 of these right now. And in fact, we were talking about the other night there, but the idea, an ADU is an additional dwelling unit, which is typically, I think there's different zoning regulations, but it's 1,000 square feet or less.
Yes.
So we're looking at really crude numbers, $180,000 to $220,000 to build one of these. So you have the zoning has been loosened up so people can develop in the backyard. So we have one, for example, right now. It's a small lot. It's about maybe 8,000 square feet, 7,000 to 8,000 square feet. We divide the lot into 2, keep the existing home, and put an ADU in the backyard.
Yeah.
And so in Seattle, they're very popular. We're doing a lot of these right now. So I'm very, very involved with that, and I think it's actually very exciting. We talked about the math on these things
is very, very good. Yeah. Well, I just looked at a feasibility study for an additional ADU on a property in Seattle, and the numbers look really strong. So if you can build an ADU for $180,000 and rent it for $1,000, $1,200, $1,500 a month, those numbers will work all day long. I don't even need to run a spreadsheet to know that. So again, the answer is ADUs they could potentially be a really great way to add value to the property.
And there's a lot of different layers in there. There's some people building 1, 2, 3 of these. They've put condominiums. They're maybe slightly harder to get rented out or get lease or financing on. So that's complicated. But ADUs has a lot of potential.
Yeah.
And there's some absolutely gorgeous designs. Actually, April's been working on with some of our investors. And so if you're looking for something that's just under a really affordable housing, is what we're seeing, and holding on to that, I would strongly recommend that. So.
And here's one more thought too. If you're a younger investor and you're trying to leverage up I've seen people get a house, put an ADU in, and then they live in the ADU and rent out the house. So they're trying to maximize that. So that's a lifestyle choice, obviously. But if you're younger, you're just trying to get that snowball rolling, that leverage that Casey talked about. That's one way to kind of reverse the tides a little bit and try to make that work for you.
Yeah, that's good.
Hey, Willie, to add to that real quick, you can put a little amount down too when you're doing. You can treat it as a primary residence if you're doing like even a 4-unit. If you said like a lifestyle choice, like, hey, I'll live in 1 unit and rent the other ones out. So you can put significantly less down, not have to put that 20 to 25% down. So that's kind of I always encourage like some of the younger clients that have like a long-term goal to own real estate and develop it, buy something like that as a primary, live in it. I had a friend who did that, and you buy one every year, live in 1 unit, and then move out, go buy another one as a primary, move out, and then you got these primary residence rates. So,
I had one in Casey in West Seattle. So we bought an old home, and we put an ADU in there, and it was a cutest little thing.
Mm.
And we're just getting it finished, and people are literally knocking on the door. They want to buy it, and that's what's happening. So people are checking these out, and they're coming after them. So very popular, and they rent really fast. So yeah, I would definitely, it's worth the conversation.
Yeah.
So
Great question.
yeah. So anyway, guys, I think we're good to go. We've covered everything. I want to say thank you for listening. Hopefully, it's brought some value to you. Maybe we'll do more of these if you like that. And any questions, please reach out to Willie, Casey, and myself. We're definitely very much trying to be a trusted advisor, long-term relationships, and we enjoy doing this.
Yeah,
It was fun. And
Very
so,
much so.
Casey, I appreciate you, my friend. Thank you for taking time to share with us. And Willie, thanks for opening your office up.
Yeah.
And,
My pleasure.
thanks, guys, and have a good night. Thanks so much.
Good.
Bye-bye.
Thank you. Good night.
Thank you. Bye-bye.